Good morning, guys. First, sound check and everything sounds all right. And B, can y'all see the charts? Are they showing up properly? Okay, great. Thank you, JD and Jim. Okay, so let's get started this morning. So obviously, 2 points I want to make. First of all, obviously, we're in a downtrend, and B, obviously, we're gapping up. So, and then the third point is there's economic data. It is housing related. It is so I normally don't care about the economic data. All I know is that in talking to some of my peers that the housing data has been generating negative reactions in the market. So keep that in mind. That's about as much analysis as I do on the econ, and I have no edge there. But at any rate, there's the warning signs for this morning. So. And also, the second part is the nature of the market has changed slightly. We've been getting sales almost every single day. Even on drives up, at the end of the day, have been getting responsive sellers. So a bit of the character has changed. So where am I looking for longs today, and where am I looking for shorts? So the first area I will be taking a long from is this 46.44. Okay, there is support here at 49 to 51. My concern is that would just break Friday's low right here, and it's relatively poorly auctioned. So this one needs, for me to take it, needs tick divergence. Hence, it's not even colored, but it is there. You need to be aware of it, particularly if you're short coming in here. Would not be unusual to see a responsive buy here and a backside test of Friday's lows. Also, a character change that is started is the backside tests here and here. From breakdowns, and I'll show you the chart if I have it up still. Here is the chart from the 25th. Okay, that was Friday's charts right there. So the first thing I noticed is that the backside tests are actually providing a good trade location. That's essentially, I was a little bit early on the 60 short on Friday. I don't have a simple way of saying when this is a good trade and not a good trade, besides looking at the counter rotations back up. But one thing I will make a note of today is obviously this downside rotation here was from essentially 67 down to 55, 12-point rotation down, and the counter rotation was obviously 55 to 62, which is a 7-point rotation up. So a little bit, we had a 2-to-1 ratio in terms of downside rotation versus upside rotation. Again, same thing here. This is roughly 53 and change up to 60 and change. Again, another 7-point rotation. So the first thing I'm looking for are the moves up larger than 7 points or smaller than 7 points this morning? And secondly, on the rotations down, are we getting that? Are we going to maintain the same ratio? If it changes, all it tells me is to look for a change in character. That's all. That's all it means. It's nothing more dramatic than that. And by the way, let me I have not put out, going back here real quick, copy of today's chart. So let me do that really fast. Which are the zones below? Okay, give me just a second here. I'll get it copied and put out for everybody. There's my zone. There's my chart. Hold on one sec here. Okay, so let's put so much of this we can squeeze in one chart. I think everyone can still read that. Put it like this. We get a little bit of space out. Okay, everyone should be able to see that clearly. And let's just make it like this. That didn't work. Oh, and you know what I don't have on here? Globex high and low, so make sure you add it. I'll add it here real quick. And here is, sorry, I totally forgot it this morning. I didn't go through my checklist. There we are. Okay, everyone should be able to open that without any problem. And then let me add Globex high and low here really fast and see if I need to make an adjustment. Let's see, 1867.75. Oh, that's nice. Perfect. Makes my job easier. Fell right in the zone. Okay. Apologize for the pause. I just want to. And then what do we have on the bottom was 1858. And there's no zone at 1858. Okay. Okay, that creates a small issue for me. Let me see if I can fix that real fast. Let me think through this. Whereas I can't really fix that. Okay, so Globex low is in the middle of no man's land. Okay, so in this particular case, get rid of the white zone today, guys, because we are highly likely to come in for a test of Globex low or Friday's low, and that would put us at gap fill at 1860.50. So I tell you, this is how we're going to fix that. Is remove this, and then we will. And do I want to make this a white zone? I don't want to make this a white zone, so just get rid of that. It's right in the middle of the range. But we can make the 1858 to 1860.50 a zone. I prefer Friday's low, but I'll base it on rotation. My concern is, actually I'm not. I'm going to leave them as individual points. If I was going to choose a point to trade off of, at this point it would not be gap fill. It would instead be the backside of that, Globex low. But it's awful location. You can see it was a terrible place to place a trade Friday afternoon. And so I'm probably going to opt to skip this area, and if it holds, I just missed the trade there, is what I think I'm going to opt for, because I was all right taking it. Actually, gap fill, I'm all right if we get a good rotation there. The problem is now I'm probably not going to take a trade here at all, and I'll think about it for the next 15 or 20 minutes, but for right now, I'll adjust this area, get rid of the white zone, and I'm not going to take a trade at all because I don't want to get caught in the middle of crap in there, and this was the middle of crap on Friday. I don't have a better way of resolving that. So now, on the long side, I'm targeting Friday's low, first test of Friday's low for a potential long, considering the rotation at this point would be an 8-point rotation down. I'm not taking a trade here automatically. I am taking a trade here almost automatically. This is the only thing that would change my mind is open drive lower or open drive higher on the trade plan. The other thing to keep in mind, this is the downtrend right here from Friday. It does not mean that we'll necessarily do this. We could simply follow it down and not even break it. We could just follow it down, dribble down all day. So that's something to keep in mind. I'm going to go look at the volume profile again one more time to make sure I've got this right in just a minute. So on levels lower, let's discuss that. So, okay, the problem below 1841 is that all of it is incredibly poorly auctioned all the way down to 1826. Okay, that's essentially a 14-point area. What happens when we get to poorly auctioned areas is this type of trade action. Excuse me. Get that right. We get this kind of trade action where we either get small rotations up and then flush, okay? And also, keep in mind, this doesn't have to happen in one day. We're still most likely to have, remember, markets close on lows very rarely. Usually, we have the exact kind of price action we had on Friday. It almost always looks like this: push up, come down, bottom third, and then in the afternoon they make a decision as to which way they're going to take it. And also the reversal hours, 9:30 to 11:30, and that's exactly what we got right on cue on Friday, midway through Friday morning. Okay, so keep this pattern in mind. It's extremely common. This one, where we just close on the lows of days, the low of the day, is very rare. Also, keep in mind, a lot of what was driving the market up has been the Q's momentum higher, and it is quite clear from multiple angles that the momentum in the NASDAQ stocks has died. It doesn't mean we can't have a big snap back to the upside as we've seen, but that is a issue to the upside, and it also means that I expect at zones above to get good responsive sell opportunities. So below here, I'm really looking for tick divergence, and I'm scaling probably a larger amount until we get stretched. So let's talk about the stretch locations. Okay, so this is an open gap. It is a poorly auctioned open gap, but it would be an ideal place to get a responsive buy and push back up for the day. Okay, so meaning it could take several days to get down to that re-auction down to that 1826. It doesn't have to do it all in one day. And that responsive buy can come just like this, right? It was a good rotation up, followed by a push down, and then end-of-day short covering. By the way, the end-of-day short covering works the flip ways as well, right? Let's say this price action had come right after New York lunch or during New York lunch into the 1 or 1:30 hour. I would normally expect responsive sellers to step in after the rotation up and push down. So if at the end of the day we get this responsive push up, I'm open to the idea of getting a push back down in the last hour. Of course, I don't trade the last hour, but that doesn't mean that if I'm not trailing off or leaving trailers, if I get position around 1:30, that I won't try to leave trailers back to the downside for an end-of-day move. And let's see. So here, I'm definitely looking long at the open gap. So that's I showed as 1839.50. I checked with a couple people. Some people show that as 1840. So somewhere right in here, right in front of this gap, I expect a responsive buy. The danger is it's poorly auctioned, and we could come down to this 1836 level. So there's no good way of saying that this trade will definitely work, but open gaps are one of the highest responsive buying opportunities. And generally speaking, those opportunities give really good moves back up, meaning usually 7 to 10 point plus moves back to the upside. So it's worth the risk, even in a down market, for me to get there. The only exception is if we hit this before the end of the first hour, right? Now that's going to be a big move to the downside, 20 points, right? We would expect a trend day down at that point. But the key to this whole deal is, okay, so the downside, assuming that everything's correct, that the leg we had a couple of weeks ago was the first leg down, and we're going to continue to move lower and break that low back down towards 17.99, which is possible, right? That means the moves from the upside are going to be the easier trades, right? That the long trades are going to be harder to get extended. But the rotations, just like we had on Friday, should work very nicely, right? Also, the traps, keep in mind, the traps where we're breaking lows, what happens is we build a lot of momentum to the downside. People panic right when we start breaking new lows, assuming, right, that we're going to move to lower areas. And then we snap back above and close just like we did here. Okay, so what this did was trapped all the late sellers and the chasers, and all they did was get short squeezed, and they're getting short squeezed into this morning. Gosh, I'm trying to explain this because this is a change in character behavior, so let me see how to explain this. Okay, it's not necessarily an easy trap to trade, but you've got to be cognizant that breaks of new lows, if they snap back above and they close above a prior low set much earlier in the day, you have to be cognizant that we could get a good move up. Also, if you have a strong desire to short and you think, man, we're going to roll over, keep in mind the pushes back up are very common even in bear markets, and we're not in a bear market at all. Okay, we're in a corrective market, but even in bear markets, these pushes back up are extremely common. So don't chase the lows is what I'm trying to say, and make sure that you're scaling as this thing goes down. It would have really sucked, right, to get good trade location at 1860, have essentially, or even 1862, right, have essentially a 5 to 7 point move to the downside in the afternoon, and then have to give it all the way back late in the day. The other thing that I want people to keep in mind, I had one other point here that was important from the trade action the last couple of days. The swift moves into the zones like we had here are usually buyable. The good part about having a downside market is people panic at the bottom and they give great trade location. And oftentimes, if you look at that 1855, it paused right there and right at the back of the zone, and gave a great response to buy. Notice that, okay, so this was the zone on Friday. Okay, so everyone wonders what a good trade looks like versus one that takes for a long time. Look how long we're spending in the zone here. 10 minutes. 15 till you hit your target. When this came in to the backside test here, lower, 10 minutes in the zone and backside lower. So we know right now, based on Friday's action and the day before, about 10 minutes is what it's been taking in the morning to get out of the zone, right? Or at least to get off the bottom. So that means if we come into a zone like this and we spend 17 minutes here and you can't get a 2-point rotation, okay, be concerned. Would be my point. Oh, the other point that I want to make, okay, so keep in mind how my particular trade, I'm trading very leveraged, okay, and I don't care about getting every trade. The trap is when you're trading small, right, meaning, let's say you had $100,000 in a trading account and you were trading 2 contracts, no big deal. What people are trying to do is make each and every trade work, and that's fine if you're trading that small. Maybe you can wait, and maybe you know something that other people don't know, right? But let's say I get onto this trade and it took 20 minutes. And I said, forget it, I'm out, and I missed the upside move, right? That's no big deal to me because all I'm trying to do, even if this happened 3 times and I broke even 2 and then I got paid on the 3rd, right? That doesn't bother me one bit because I have so much on when the trade works for me that I get more than paid, and all I care about is growing my equity at the end of the day. And so the way that I trade, I don't need to or want to necessarily capture every single move. It's the emotional desire to capture every single move that traps traders into a pattern of saying this trade has to work, right? If you can shift your mentality just slightly to, hey, I want to get a trade that works for me pretty quickly, right? And if it doesn't, I want to pull my risk off the table and let someone else screw with it. Or the other way to handle it is, I am going to try to capture every move to the upside in small size and get a good risk-reward ratio, but if it comes down, it doesn't hurt my overall equity. It's simply 2 different ways of looking at the market. Most traders, right, and I'm not a trading service, but most trading services look at it as, hey, we want you to trade low leverage, right, and get good trade location each time and be patient and let the trades work themselves out. I look at the market differently. I don't care that every trade doesn't have to be a huge home run, and every trade doesn't even have to work if I can keep my losses relatively small, which is what usually that 25-minute rule in the zones does for me. Okay, as long as when I do get my trades and they do work perfectly, like I did right in here for a push up, as long as I get paid on those and I can control my downside risk at other times. In addition, you'll notice on Friday afternoon, this was a harder trade, and the reason why is this was a single point of resistance essentially, and there was a zone right above. It could have easily pushed back up into this area. So the way that I handled that was that I cut my trade size in half, right? I knew that it was going to take time. Why? Because I knew that we were headed into the lunch hour. And I gave myself a nice wide stop, 4 points, which means that we still could have come and given a backside test at Thursday's low, although it would have had to been perfect in that particular case, and then a rejection lower and still have the trade work for me. So either way, they both gave me good trade location in here, right? And additionally, that was my first trade and my second trade, and this was approximately halfway back. Now, most traders look for halfway back, which is what this was right here. And most of the time, what that generates is a small short squeeze, which was I was aware it could happen, right? It shakes out these guys right here that were looking for this, right? And they tend, and if you look, they simply had a rule. Look, if this trade doesn't work in 25 minutes, I'm gone, right? Then they wouldn't get squeezed up. But what most guys are trying to do is they're trying to use their same leverage they would use in other trades, and they're ignoring the time component on this. And so what I did was I understood that this was possible and simply decreased my trade size so that I could withstand staying in here and being emotionally not affected by these whips that were taking place in here. And the reason why I did this is because I recognized this pattern right here, and I was looking for a break of the lows, and we got the break of the lows. There was no follow-through on it, obviously, but this pattern is a very good trading pattern right here. It's just a matter of getting where the inflection point is going to be correct. So that's all I have to say on that. Again, so let me just finish up, and then I want to show you all something. It's 8:08. Okay, so let's get rid of this. Again, I'm looking long for responsive buys here. Exactly 1839.50, 1840 area. This is the top of structure here, but man, it is weak. And you have to keep in mind, this needs to work quickly for me. It is slippery below here. So the next place that I'm looking, if this open gap doesn't hold, is actually this 1831, 1829. That would be a big stretch, right? The only way I'm not taking this is if it comes in the last hour. And it can get busted, but the odds are heavily with you, even in a downside market, that we're going to get responsive buyers and push back up. Okay, so on the upside, let's go look at that. So we're showing 1863 to open, which is, again, that crap right in the middle. So first time into Globex highs and Friday's highs, I will take a short. I won't call it. It's not enough of a rotation up, but I'm just saying I'm willing to take it, and I'm willing to take the 2-point loss behind the zone. I don't care. This trade works out a lot when we're in downside markets. I'm willing to take the loss here. That's the only way I have to describe the risk. It's not a big rotation. It could easily come here and tag me out. There's an open gap sitting here at 1872. You got to keep that in mind. The market likes to close gaps from Friday. According to this, okay, so on the volume profile chart, the close is 1872 and a quarter. That's a tick higher on the non-volume profile chart. I don't know why it is that way, but there you have it. So 1872 and a quarter to 1872 and a half. The market likes to close gaps, and again, I would expect to push back down from that point. One of the things that's not being reflected in the larger indexes right now that I've been seeing all over the place, and I posted on my Twitter stream, guys that are heavily invested in the momentum stocks have been bone crushed in the last couple of weeks. And what you're seeing in ES in the morning is a rotation out of, I believe, rotation out of NQ and into ES, the more conservative of the two indexes. And that's why you're seeing it hung up. Once the rotation is done, we're getting moves lower, but the damage in ES is not anywhere close to what the damage is in NQ. The reason why that's important is if you see NQ start to bounce, you've got to start to expect stronger and stronger upside short squeezes and bounces in ES more so than you will in NQ. Also, I would look for the range in NQ, particularly on the upside, to start to collapse back to the old range of 15 to 30 points. It has been 30 to 60. I think on the downside we're still capable of those 30 to 60, obviously 30 to 60 point moves to the downside, but I think the upside rotations will be 15 to 30 instead of 30 to 60. I hope that makes sense. I'm going to go over the NQ chart in just a moment. And so, two things that I'll be keying off of, okay, that I had that I heard from several people. So when the market's in the hole for 15 points, even if you think it's going to go down 20, it's the wrong place to be pressing your short to the downside. Instead, I would look to get positioned, right, to the long side and look for, if you're a more advanced trader, look for the traps. If you're a less advanced trader, quite simply, first time into the zone, right, provides a nice rotation higher. This from Friday, right, this is 1872 and a quarter down to 1855. Again, once we exceed that 15 points, right, we stretched a little bit more beyond that, but it was giving actually very good long side location. The other switch you have to make that people have been getting very used to is they've been grabbing lows and getting moves like this to the upside. Well, I never expect this, but for traders who've been getting this, I seriously doubt this is going to continue unless we get way overextended over a period of days. So the other thing I want to show you all here is just so you get some larger picture, which I'm always keeping in mind, right? Because we zoom in, we get so caught up in the 5-minute charts and the 1-minute tick divergence. So I went through over the weekend and this here real quick. Okay, so this is essentially an hourly chart. Obviously, we've got to get rid of the white zone. We're not going to have that today. Okay, so a couple things. First of all, plus 20 gets us right back today to the top of this breakdown point, and this is what's deceiving is it really doesn't look like we're that far off the highs, but when we look at the NQ chart, okay, this is larger picture of NQ chart here. I mean, the damage has actually been was pretty big here, right? So I did a couple. Okay, it's 8:14. I'm going to need to be succinct here, which I'm not great at doing. Okay, this is the first leg down, right? We had a big recovery. Okay, so if we do an AB equals CD, that puts us down right here into the 1794, 1796. And I believe there's an open gap right below that at 1788. Okay, so in this area, right, would not be surprising for those that are looking for an ABCD to get at least a responsive move back up, and that means that we'd also break this structure right here. And even if we were going to complete CD equals 2 times AB, which wouldn't be shocking, right? Even if we get that we would get responsive buys in this area. I can tell you there's a ton of institutional traders that are looking to this area to get long. And so if we look, that would be a pretty good stretch, right? This would bring us back up. If we test the backside of this structure, would bring us back to that 1707 area at first. And the second test would bring us probably to a backside test of 1724, 1726. And then another leg down, right? That would make sense. The markets don't go, well, occasionally they go in straight lines, but usually they don't go in straight lines. Usually they move crooked like this, right? Okay. So if we do get AB equals 2 times that puts us all the way down here at 1710, right? Obviously, that would be a huge correction. But if you look at the math on that, there's an open gap sitting right here at 1715, right? Markets love to close gaps, and that I believe would bring us damn close to that CD equals 2 times AB. Let's see, just beyond that, right? So that would be pretty damn close. That's not an awful downside target, very extended downside target, and obviously that could take a couple of months possibly to get down to. Hopefully we're not just going in a straight line down there. That would really suck and would cause us to miss out on a lot of nice trades. The next question is this reasonable target, right? 1892, 18 what was the actual high? That's right. So 1882 down to 1710 would be 100 and, wow, I'm terrible at math quickly, but I'm going to say it's 170 points. Is that right? Let's see, that would bring 1782. 1710 is another, yeah, essentially 170 points. Is that reasonable? So the next thing that I do to look at that and understand if this structure will work, so this was 1724 to 1882, that's 160 points, right? And essentially took us from February to April to reach that. So yes, it's very possible to have this move. And then the next question is, what has been the size when we have had corrections of the downside move? Well, this move here was approximately 1840 down to 1724.50. So that, what did I say, 1840? 120 points. Okay. This move here was essentially from 1710 down to 1625, just 80 points, right? And then this move here was 1682 down to 1620, which was again another 60 points. So if we did this in so 60 points, right, has been the first place where we've been getting big responsive buys on the downside. And then this larger, the last time we had a really big large move was last year, and that was from 1680 all the way down to essentially 1530 area, right? So that's 150 points move. So we have recent examples that we can get that size down move. That's not an insane kind of move down or up. And secondly, look how long those moves took to the downside. In general, they've been taking approximately a month on the larger moves, and on the downside, approximately 2 weeks, right? So the market keeps a relative rhythm going. So if we were going to take a first leg down, which would have been 60 points, so 1880 would put us at 1620, would be a 60 point leg. If we stretch a little bit because we're getting weaker, it would put us right to the bottom of this structure right here, right? And so if you look, we have an open gap from right here at 1760. So that would make sense too, right? This is roughly 60 points. This is roughly 60 points right here. And this is roughly another 60. And then if you add a third 60 leg, it could come in thirds, and it probably would look something like this to the downside, and then I would expect responsive buying back to the upside. Also keep in mind, the counter rotations can be big in this. It can look like this, right? And then legs down like that. So don't get overly bearish and let the market step you into your trade location, and let your trailers pay you to the downside if we're getting the downside move, right? Now, on the chance that everyone's wrong and we're not getting the downside move, or shorts get too aggressive too quickly, right? This is essentially the bottom of our current trading range at 1630, right? With breaks just below that trapped above. So if this is our larger trading move and we're simply going to work it off in time instead of topping out, this will be the bottom, right? With extended moves down, trap back above, and move to the top of the trading range is option B, where we just balance, and that would frustrate the majority of people, right? Bears don't get their payday on the downside, bulls don't get their payday on the upside, and guys like us just get paid trading back and forth, which is very nice, okay? And then our third option obviously is we break once. Last time we broke to the upside, it took 3 shots, I believe, before we finally, let's see, 1, 2, 3, and then we finally broke and failed, right? So if we took 3 shots up here again, if we finally closed up here, it would obviously potentially trap everyone down here and give us an additional move higher. And I'm open to either side working out. I'll let the market guide me into, and the price action guide me into, which way is stronger, and I'm not going to have too much conviction on either side other than the price action will tell me which way we're going to go. We'll find out pretty quickly based on the response on NQ. Also, in the mornings in weak markets, we tend to get this pattern right out of the gate where we get responsive sellers at key areas early in the morning, guys that were trapped earlier, right? And then moves higher versus these open drives higher. So it's 8:22. I want to talk about So now that I covered that, and I hope that helped. So that being said, what's the first thing that I'm looking for? Open drive higher, right? We categorized 1, 2, 3 bars. First bar being the low, 5-minute low, right? And not getting penetrated. This is the easiest way. It's not the only way, right? The other way is one very large bar, open drive higher. I expect responsive sellers on open drives higher right now, even if it's just a halfway pushback and then a continuation higher, right? So I'll leave trailers to try to make it work here. Also, midday in these kinds of markets, if we are, again, weaker, as I think we are, midday will tend to get balance and then break down in the afternoon, which is essentially failed range extension. This pattern has not worked very well in the last 6 months overall, but I got a feeling it's going to become more predominant on the upside. And then again, I got to reiterate, bullish or bearish, it's a bad idea to chase in markets that go down. We get a lot of this pattern. It's a terrible idea to press at the lows. And if you're patient, and here I'm going to go back to this chart really fast one last time, even if I don't get to cover the other stuff. Where is that? This was... Okay, so we'll shift this to a 15-minute chart. I want to point out that the moves back to the upside were sharp, and they're not necessarily tiny moves, right? We had one trend day down that broke it, but if you look the following day, look at the rotations back up, even though we continued lower. This is what I mean by open drive higher, push down, and then push back up, and then later in the morning to midday, push lower. Same pattern here, right? Push down, push back up, end of day, push back up, push higher, push lower, push way back up. People got overly aggressive in these short areas down at the bottom, and this is incredibly common. If we go back and look at the prior down cycle, right here, same thing, push back up, push lower, right? People got overcommitted to the downside, they got squeezed, and if we go to the prior down cycle, I'm going to find the big one. This is sideways. Again, different market. Let's go back to the last time we were really lower. Okay, pushes lower. We had one trend day, but everything else, look, even though we're in a down market, started to push up, right? And then let's go back to last year really quick. Right click, background dragging, disable, and restore original scale. Okay. We'll find where we really got bone crushed. Okay. Downside move, right? Trend day, one trend day down where we closed on the low. Everything else pushes back up, right? If you got too aggressive on the short side, that's what this is. This pattern, again, much more common, right? Even with early drives down. So I think I made the point. Don't get aggressive. Don't get overly aggressive late in the push lower, thinking we're going to zero. The market's probably not going to zero. There's a difference between crashing market and a correcting market. Don't get the two confused. 8:26. I want to wrap this up real quick. A quick look at the NQ chart. I need to post these. Just larger picture, right? This brings us AB. So if we get, there's two ways to look at this. This is AB equals CD. If we get this, we get a higher low here at 34.20 and responsive buyers, right? If we get this would be a potential area of retest at 3404. First time in, I would expect responsive buyers, right, to give us a push back to the upside. There's an open gap just below at 3390, and then right below that at 3354. Obviously, we can stretch up to 90 down. If we get 90 down from 1531, it'll put us at 3440 roughly, which is right below this open gap. So it is possible, if it gets ugly, right, to get a push back up. We have Fed this week. Obviously, the Fed's been having less and less influence on the pushes to the upside. People are going to be aware of that and not be as worried. However, in front of the Fed, it's not unusual in front of big numbers to get people to square up their shorts, especially if the market's going down, just in case the Fed does something and ends up boosting the market, right? As in, we're going to increase QE, we've changed our mind, the data looks different, right? Or just as so many people pack in expecting them not to change policy and still generate a short squeeze back up, only to have it get bone crushed back to the downside. Either way, the pattern's changed, and people who are just blindly buying dips are getting their balls squeezed very badly. It's not a very pretty picture. It's 8:27. I'm going to take a minute to get ready to trade today. Guys, I will print let me copy this chart and get it right out to y'all on the ES. And I hope everyone had a great day. I didn't get everything covered, but there's a lot to look at. So the data's at 10 o'clock. Don't forget, we usually get kind of this wishy-washy stuff right in front, right? If it's really weak, we'll start to break in the direction, or really strong, we'll start to break in that direction prior to the